August 2, 2024, will be etched in the minds of investors as a day of significant losses. It was a day that started like any other but quickly turned into a financial nightmare. The stock market, often seen as a barometer of economic health, took a nosedive. Investors watched in horror as their portfolios shrank within hours. The S&P 500, a key index, plummeted by 2.5%. This drop erased billions of dollars in market value, leaving investors reeling. The Dow Jones, another major indicator, shed a staggering 954 points. This was one of the largest single-day drops in recent history. Even the tech-heavy Nasdaq couldn't escape the carnage, dropping by 2.9%. Tech giants that had been market darlings saw their stock prices tumble. What triggered this sudden and dramatic downturn? Investors and analysts alike were left scrambling for answers. A confluence of factors, including a dismal jobs report, sparked a wave of fear and uncertainty among investors. The report showed a significant slowdown in job creation, raising alarms about the health of the economy. This wasn't just another bad day on Wall Street. The scale and speed of the decline were unprecedented, causing widespread panic. The market's freefall pointed to deeper anxieties about the U.S. economy. Investors were not just reacting to the day's news, but to a growing sense of economic instability. Fears of a looming recession, fueled by high inflation and rising interest rates, sent investors scrambling for the exits. The combination of these factors created a perfect storm of financial distress. The question on everyone's mind: is the U.S. economy headed for a downturn? As analysts pore over the data, the uncertainty continues to weigh heavily on the market. The July jobs report, released on August 2nd, landed like a bombshell on an already jittery market. Investors and analysts had been on edge anticipating the numbers, but the reality was far worse than expected. The numbers painted a bleak picture. Only 114,000 jobs were added, a far cry from the 215,000 expected. This significant shortfall highlighted underlying issues in the economy that many had hoped were temporary. To make matters worse, the unemployment rate ticked upwards to 4.3%, defying predictions of a decline. This unexpected rise in unemployment was a stark reminder that the labor market's recovery was far from stable. This unexpected rise raised red flags about the health of the labor market. Economists began to worry that the job market might be entering a more prolonged period of weakness, which could have broader implications for the overall economy. The dismal jobs report sent shockwaves through Wall Street, confirming investors' worst fears about a slowing economy. The immediate reaction was a sharp sell-off in the stock market, as traders scrambled to reassess their positions. The Sahm rule, a closely watched recession indicator, flashed a warning signal. This rule, developed by economist Claudius Sahm, is used to predict the onset of a recession based on changes in the unemployment rate. The rule, based on historical data, suggests that when the 3-month moving average of the unemployment rate rises by 0.5 percentage points or more relative to its low over the previous 12 months, a recession is likely. This indicator has been historically accurate, and its current signal is causing significant concern among economists and policymakers alike. The tech sector, once considered invincible, found itself on the receiving end of the market's wrath. Industry giants like Intel and Amazon suffered major blows. Intel's stock plunged by a staggering 26% after the chipmaker announced a significant quarterly loss and plans for massive layoffs. Amazon, the e-commerce behemoth, saw its shares tumble by almost 9% following disappointing revenue figures. The tech sector's vulnerabilities were exposed as investors reassessed their growth prospects. Rising interest rates, designed to combat inflation, increased borrowing costs for tech companies, many of which rely heavily on debt to fuel their expansion. Fears of overvaluation in certain tech segments, particularly artificial intelligence, added to the downward pressure. The market's sharp downturn and the gloomy economic data have fueled speculation about the Federal Reserve's next move. Traders are now betting on more aggressive interest rate cuts by the Fed, the central bank responsible for setting interest rates. The market is currently pricing in a 70% chance of a half-point interest rate cut in September, a significant shift from previous expectations. The Federal Reserve faces a delicate balancing act. Its mandate is to maintain price stability, meaning keeping inflation in check, while also maximizing employment. The recent economic data, particularly the weak jobs report, suggests that the economy might be slowing down, prompting the Fed to prioritize supporting economic growth over curbing inflation. A global ripple effect. Japan feels the heat. The negative sentiment that gripped Wall Street on August 2nd reverberated across global markets. Major indices worldwide, from Europe to Asia, experienced significant declines. Japan's Nikkei 225, a key benchmark for the world's third-largest economy, tumbled in sync with U.S. markets. The interconnectedness of global financial markets means that a shock in one part of the world can spread rapidly to others. The U.S. economy, the largest in the world, plays a pivotal role in global growth. A slowdown in the U.S. can have ripple effects across the world, impacting trade, investment, and financial markets. Oil prices, a roller coaster ride. Even the price of oil, a critical commodity and a bellwether of global economic activity, wasn't spared from the market turmoil. Oil prices initially surged on August 2nd, fueled by concerns about potential supply disruptions due to geopolitical tensions, particularly in the Middle East. However, the rally proved short-lived. Fears of weakening demand, driven by the potential for a global economic slowdown, outweighed supply concerns, causing oil prices to reverse course and end the day lower. The volatility in oil prices underscores the uncertainty surrounding the global economic outlook. Recession fears grip investors. The stock market's plunge, coupled with the weak economic data and other warning signs, has intensified fears of a potential recession in the United States. The SOM rule, the recession indicator that flashed a warning signal after the July jobs report, has heightened anxieties among investors and economists alike. A recession, generally defined as 2 consecutive quarters of negative economic growth, is a period of significant economic contraction. It's characterized by job losses, declining business activity, and reduced consumer spending. While the U.S. economy has shown resilience in recent quarters, several factors point to a potential slowdown, including high inflation, rising interest rates, and weakening consumer sentiment. Jobs on the line? The recent stock market turmoil and the broader economic concerns have raised significant worries about the potential impact on the job market. Investors are jittery, and the ripple effects are being felt across various sectors. A slowdown in economic growth could lead to reduced hiring, increased layoffs, and a rise in unemployment. This is particularly concerning for industries that are already struggling to maintain their workforce levels. Companies facing economic uncertainty and potentially lower profits might respond by cutting costs, which often includes reducing their workforce. This cost-cutting measure is seen as a way to preserve the bottom line during tough times. The tech sector, which has already seen some high-profile layoffs, could be particularly vulnerable, given its rapid growth in recent years and potential overvaluation. Startups and established tech giants alike are feeling the pressure to streamline operations. A weaker job market would have far-reaching implications for the overall economy. The effects would not be limited to just those who lose their jobs, but would extend to their families and communities. It could lead to reduced consumer spending as households face job insecurity and lower income growth. When people are uncertain about their financial future, they tend to cut back on non-essential purchases. This, in turn, could further dampen economic activity and potentially create a vicious cycle of economic decline. Retailers, already hit hard by changing consumer habits, may find it even more challenging to stay afloat. Stay informed, stay engaged. The events of August 2nd serve as a stark reminder of the importance of staying informed about the economy and financial markets. These forces shape our lives in countless ways, from our jobs and investments to the prices we pay for goods and services. By understanding how the economy works and the factors that drive market movements, we can make more informed decisions about our financial futures. There are numerous resources available to help us stay informed, from reputable financial news websites and publications to educational materials offered by financial institutions. By taking the time to educate ourselves, we can become more informed investors and consumers, better equipped to navigate the complexities of the global economy. Join the conversation. The events of August 2nd have sparked a vital conversation about the health of the U.S. economy and the outlook for the future. What are your thoughts on the market's downturn and the factors that contributed to it? How do you think the Federal Reserve should respond to the recent economic data? What steps can individuals and policymakers take to mitigate the risks of a recession? Share your insights and perspectives in the comments section below. Let's engage in a thoughtful and respectful dialogue about these critical issues that affect us all.